Prices have cooled off since hitting a high in the month of June this year. China has shown some laxity to its steel producers this winter season, triggering concerns of another sharp correction in both hot rolled coils and rebar prices. But what's cushioning the fall is the correction in raw material prices, helping steelmakers hold on to their margins. And come April, things may even get better. Nickey is here to take us through the factors at play. Nickey, good morning.
Good morning. I'm going to start off with the HRC prices, which currently trading at 1-year low. Clearly a cause of concern for all the steel makers. If you look at the move, this is the second consecutive month that the steel prices have now fallen. And if you look at the level, that's almost a level that we're looking at a year low. What is really leading to the fall? Well, we'd map it back to the international prices, which are also moderating since the month of October. If you could pull out the chart that we have next, we are looking at a price of $490 metric ton, which is further moderated from $495. Now you could see the steep correction coming in from the month of October. This is mainly on account of the lenient measures which have been taken by the Chinese authorities on account of the cut that we could see in the production, which has led to higher production in China market amid the trade war tension, which in turn has exerted the pressure on Chinese prices, which in turn have been reflecting on Indian prices. But how this can be arrested, or whether or not this can be arrested, let's look at the parameters. They're kind of comforting right now. Let's look at the spreads or the margins, as you may say. Well, they remain healthy, 24,251 per ton. That's the December figure that we're talking about. They remain healthy pretty much at the 8-year high level that was seen back in May 2018, which was around 27,145, which means that the margin pressure yet is not coming for steelmakers, which in turn they may not be in the dire need to go ahead and cut their prices in order to boost sales. Next point that we have is Chinese exports show signs of ebbing. Now that's a good news for Indian markets, because for the second consecutive month, the Chinese exports in terms of value, they've been slow. We've seen an 8% decline coming in on October and a 3% decline coming in for the month of November. Also, if you look at the inventory levels, they're almost at the lowest level that we've seen since March 2010. We've seen a liquidation happening, and because of which inventory are at their lows.
Interesting. So if these cues selectively are looking positive, Nickey, what are analysts saying?
It's a mixed picture. They're saying a temporary pain coming in for the steel makers, but then they don't expect that to last for too long. What Edelweiss has to first say, they say the rising raw material prices in China to stem export price drop, which means they're not expecting a further slide coming in on the Chinese export prices, given the rise that we've seen in the raw material prices. ICRA, on the other hand, says that the steel prices are expected to fall till Q4 of FY19. They may regain ground as the construction activity picks up in Chinese, which they estimate with a timeline around FY 2019. And last in the list, we have high towing, which is suggesting that the scale down in trade war is expected to benefit the steel consumption from April 2019 onwards. Clearly, this fiscal, we would see the steel makers have some impact on account of steel prices. Separately, we have a contradictory note coming in from Macquarie Wealth Management. It's a sales note that they spoke about, where they did a survey and they found out that the sentiment in China still remains weak and the utilization rate has fallen on account of higher inventory levels.